Lance, welcome to the group here.
Yeah, thanks for having me.
Um, I think I first met you back when you were working at a previous business,
Yep,
Veravest, right?
correct.
Yeah. And now you are doing something else. I'll let you go into those particular details. But the reason we called you in here today is because I thought there was a lot of value in one of the tools that you have. It's a tool that helps people understand how to ask the right questions of general partners and to evaluate a fund. And then it even takes it a couple of steps further than just evaluating a single fund, but it allows the LP investor to actually stack those funds together in order to evaluate their overall cash flows and set goals and metrics towards becoming financially free. It's a good tool, and I will let you introduce yourself, what you're doing now, and walk us through the
Yep,
tool.
very good. Yeah, so as always, and this is sort of my style, is to be educational first and foremost. So more than anything, I hope you learned something today. Not necessarily here to sell you anything. That's just
Yeah.
not my style. But yeah, so
Oh,
this is
one
it,
other thing too. If you have questions, feel free to put them in the chat.
yeah.
And Lance, I'll monitor the chat for you so you can focus on your talk. And if something comes up that's pertinent, I'll judiciously interrupt you and ask the question, unless you want to keep the questions until the end.
No, that works. Yeah, if something's pertinent, yeah, need clarity. Yep, go ahead and ask it. So, I mean, we'll be moving quickly today. I also talk fast, but you're a smart group, so we'll presume that you can always watch the recording if I get you turned around. But so we're going to talk today about kind of the seven key metrics that really make or break a deal, which is our tools trying to do is just remove friction from the evaluation process when you're evaluating a deal. In this case, a multifamily syndication, how to determine whether a deal is well aligned with the sponsor, knowing the ratio of the cash flows from operations versus the proceeds of a refinance or sale, why that's important, how to evaluate, proposed loan terms of a deal, the types of debt, as we were just kind of talking about, the devil's in the details. And then, kind of a five-step process for properly vetting a sponsor before you invest. A bit about me. So actually, I spent 20 years in Portland, Oregon, so I'm very familiar with Intel. I have many friends who work for Intel. I used to live in Hillsboro in Orenco Gardens, not far from any number of Intel campuses. Um, Moved to Houston, Texas 3 years ago. Love it down here, like the warm weather. But yeah, so I'm the co-founder and CEO of Passive Advantage. Uh, and I also have a consulting practice. I work with lots of GPs and have for like the last 15 years, operators, private lenders. I've created a kind of a framework for growing and scaling real estate investment firms called the Empire Builder Formula, which is somehow spelled wrong. In the past, I was a partner of a private equity real estate firm based in Portland called Fairway America, and I was the founder and managing partner of a fund administration firm called Veravest, where I did a lot of fund advisory work. My first go around is I started a company in Portland called Convergence Networks when I was like 21 years old, and built that up and scaled it to 5 million plus in revenue and sold that. And then I got into real estate. So I've done a lot of fund advisory work. I've worked with well over 200 real estate entrepreneurs around the country forming their pooled funds. We scaled that fund admin business to over 3 billion in assets under administration, primarily from a bunch of high net worth investors, that capital was coming from. Got a lot of experience with that. A lot of experience with lending. And yeah, my claim to fame is I was sort of like one of the pioneers of the IT managed services provider business model. Did a lot of work with Intel. There were some products that came out back in the day for remote management. But I was kind of rode that wave, how to support computer networks over the internet. And really that's become kind of the de facto standard these days of how things work. So but starting with, how do you quickly evaluate a deal? I mean, this is sort of how I do it, right? I mean, first and foremost, I mean, at our private equity real estate firm, we were an allocator of capital. So our job was to go vet sponsors, and then we would vet either their blind pool fund or their individual deal. So that's really what we were good at, was like finding sponsors, usually operators, real estate operators. How do we figure out whether these guys are any good at what they do or not? Are they got the stuff or don't they? If they pass our due diligence, they make our approved list, and then we'd be willing to evaluate an opportunity to potentially allocate capital into. When we started, we were writing $500,000 checks, usually into deals as LPs. Hopefully, we'd get some enhanced economics, information rights, minimum. We'd cut the best deal we could. Over time, we got to the point where we were bringing, 90% of the equity, more of a true like co-GP kind of joint venture type situation, where we're raising and allocating, 9, 10, 12, $15 million of capital for a given project. Um, but anyway, so I mean, that's really the first and foremost the thing that you want to focus on. Then we want to look at is this deal, are interest aligned? What do the fees look like? Really digging into their underwriting. What are those key inputs of rent growth? Kind of the assumed exit cap rate. How are they looking at that? Obviously, has a huge change in what the projection is going to be, and then comparing those expenses to the T12, and then calculating yield on cost. So we'll talk a bit more about that as we go through. So that's kind of my quick vet, what I would do, and here's kind of how you can do that. So one of the things I always look at when I'm looking at a sponsor team is just to see how many of what I think are kind of the 4 key roles are filled by different people. So who's in charge of acquisitions, who's in charge of asset management, who's in charge of, fundraising, I guess, / investor relations. And the one I don't have on here, I'd call is like the back office, who's making sure the books get done. Um, and then if they handle property management in-house, if they're vertically integrated, I want to know like who's the person that leads that charge, and do they have experience managing properties of a similar size? If they're really deep value add guys, then I'm going to want to make sure they have someone with lots of construction management experience. So if they're putting $30,000 a door into an apartment, and doing that at scale, then there's, as far as I'm concerned, there's much a construction company as they are anything else, because that's hard work. But if they're doing deep, heavy value add projects with no one on the team, just relying on some general contractor alone, that makes me more nervous. And then I'm just looking for situations where any one of these people might occupy one or more seat. So, and obviously with emerging sponsors and operators, it's not, they're not always going to have all these filled. But to me, the key ones is acquisitions and asset management. I just think are really important. It's one thing to hunt deals, but to hunt deals and try to, be the person in charge of executing the plan at the same time is a little more challenging. And then you were looking at, has the sponsor purchased deals of the size before? They have experience in the market. Obviously, full cycle deal experience is good to see because it just proves that they can at least, take a deal full cycle. And then I think the big one, especially when you're evaluating like a pooled fund, is just going back and looking at their pro formas versus the actuals. I mean, we did that all the time. Lots of LPs don't feel like they could ask for that kind of information. But, for us, we're kind of pro LPs. It just, I mean, that tells us what they're all about, right? Anyone can say they're conservative underwriters. You need to be able to prove that you are. And you can prove it by showing me, here was the model that we created before we did the deal, and then looking at actually how it turned out. Now, no one's going to be perfect. Obviously, it's a pro forma for a reason, but it's just you get a sense of how they approach and how they make assumptions and how they look at things. There's clues inside of there. I mean, so those are the main things that I kind of look at. And obviously, you want the makeup and experience of the team is important. You want to make sure it lines up with the strategy, right? Because and what they say their business plan is this, you just want to make sure that they've got the people that have the experience to actually execute. And if they don't, then your execution risk increases, and you need to be compensated more for investing in that deal if you decided to invest. And then the property management, I mean, sometimes it's not always, I mean, everyone loves to say they're vertically integrated, and I'm sure it's great. But once again, it's like if you're vertically integrated, you have to be good at it. It has to be a competency. So those are the things you want to dig into. If they're not vertically integrated, it's the same exercise. You need to look at that property management firm and see, do they manage other properties like this? Are they any good? You want to dig into it a little deeper. We don't have enough time here today to go into all that, but those are the things that I would be looking at and that I do look at and we did look at. And then when it comes to alignment of interests, we look at, there's a preferred return. The preferred return, in my opinion, right, is just to protect the LP's downside risk. That means, hey, you're going to have to deliver this to me before you get to, any of the upside in the deal. Um, and so that's just usually going to tell you, however much that preferred return is also usually an indicator of how much risk overall is in the deal. If it's a core deal, a core plus deal, it's 5 to 7%. That makes sense. Um, but that wouldn't make sense to have a 5 or 6 or 7% preferred return in some deep value add or highly opportunistic sort of opportunity. Right. So it's just understanding that you're trying to figure out what bucket is this, what risk band is this particular deal in, and then weighing whether or not that preferred return sort of fits with, where we're at now. In theory, because interest rates have gone up, these pref rates should also climb along with it. Because when we look at when money was free and the standard pref was 8%, that's 800 basis points or an 8% risk premium ostensibly. That's kind of how I look at the world, is like, what's risk-free rate? And I think that's why a lot of people are pencils down right now, because it's just, I mean, we had it really, really good, right? Like before, and now, and as rates go up and I can get a risk-free rate that high, I can see why people think it's doesn't make as much sense to invest, just because you're taking on some amount of risk and the chance of something goes sideways are much higher. You just want to look at it that way. And then you might see no pref, lower promote structures. I'm not a fan of them. I like when there's downside risk is protected, right? But so if they don't have a pref and it's just straight split from day one, you have a misalignment of interests. And then the other thing to look out for, right, is the sponsors claim they're going to pay pref current from day one. Pref should be paid out of net income, right? Like NOI. People that are like overfunding equity and then paying pref back, that's a return of capital. And I see people do that over the years. It's a misnomer, and I'm basically just giving you your money back. That makes no sense. But then saying that I'm paying distributions, that's silly. And really, once again, it's just categorized a return of capital. Now that pref is calculating accruing on a lower number, it just doesn't make any sense. So you want to look at those sorts of things, because if it's
Hey,
a deep value added deal, that makes no sense.
can I ask a follow-up question there?
Yeah.
If you're looking at a deal and they're paying distributions from day one, does it necessarily follow that they're over raising on their capital and then paying it back to you? Or how do you like to look at that? And when do you think a deal should begin their payments? Obviously,
Well, I
depending on the
mean,
deal,
I
but what
guess
do you
for
like
me,
to see?
I look at it and just say, what kind of free cash flow is the property? If the property is generating free cash flow, then go ahead and distribute the free cash flow,
Hmm.
right? Like, even though that means that you're only paying what amounts to a annualized one pref or two pref, or, like, of the pref, you're only paying some portion of it. But don't ever send cash out and distribute cash in excess of the free cash flow or the net income generated, because by its very nature, you have to categorize it as a return of capital,
Yeah.
right? And so to me, it's just, yeah, I mean, distribute free cash flow, like, knock yourself out. But if you're not generating any free cash flow, then you shouldn't be making distributions. Because where did it come from? You either borrowed it from the bank, or you got it from you overfunded equity, and you're just using cash that wasn't generated. It was generated by some other means, not operations. And then ultimately, like, when you look at pref rate, this is what I look at, is just, with that said, I'm looking at the pro forma of the deal and I'm just saying, I want to see that preferred return rate be at or near or somewhere in the range of what's actually being generated. I mean, there's nothing wrong with, you're going to have a pref that's going to accrue over time, and I'm fine with that too. It's just understanding there's a distinction there, right? Because it could be a 10 pref, but really in year one, it's going to generate 4% annualized yield, then 6, then 8, and the rest it's going to accrue, and you'll eventually get it if the project is successful. So that's why the pref, matters. And then when you're looking at the promote, so if they reach that pref, what is the promote? The average to retail investors is usually 30%. In real estate deals, there's usually not a catch up. So there's an 8 pref and a 70-30 split. But anytime you see deals like, 8 pref or 10 pref with a 50-50 split on a multifamily deal anyway, I don't like that, as much. I mean, I like it to be, I just feel like it starts to get to the point where it really acts more like a 50-50 deal, and it's just not as well aligned. It's all about alignment. And a lot of times, guys, when they get into space, they're able to go to friends, family, relatives and cut deals like that, 50-50 deals, or even, the inverse, where they're getting more than 50%. It just, that's sort of an indicator that this is sort of amateur hour and these guys don't really understand what market rate really is. And then you could have multiple tiers. Just keep in mind that those tiers, if it's like there's a second hurdle rate and then it splits more. I mean, I'm all for it. It's just understand from the LP's perspective that often there's great optics. Like it looks good, like it seems reasonable, but any second hurdle I want is usually should be closer to a really stretch on the project, right? So if they say it's an 8 pref with an 80-20 split up to a 15, I want to know that the risk level of the overall project is around 15. So if they hit 15 and get into this higher split, that means that they really outperformed. But if like that hurdle is lower, it's a deep value add deal or some development deal, and that hurdle's at 15, I just feel like that's misplaced. It doesn't make sense. So really, it's just making sure that promote seems reasonable on its face. And then when you talk about co-investment, obviously we love everyone to have 10% skin in the game right out of their own bank account. That'd be wonderful. I tend to look at it differently. If the sponsor, and I know they're independently wealthy, they've been in business for 40 years, you just can see enough to know they have a lot of money and they're not co-investing anything or something less than five, or don't have some other mitigating circumstances. I just think the more money you have, the more money they should put in. But we have a lot of great, and this is what we targeted, really emerging operators. So these, I will call them younger people. They're former brokers that were in business a long time, have been doing this for 4 or 5 years. We went and looked for them. Well, in their case, they've done okay, but they're not able to, they're not flush with cash, or they put all their money in their first few deals. So it's just, I'm not as much of a stickler on this point. I think it's all about asking the right questions to understand that whatever money they have in the deal, it's meaningful to them. If they lost it, they'd be close to maybe crying about it, right? Like literally would be like sick for a week or two. That's sort of my litmus test. And then on the deal fees, like sponsor fees, it's the same thing. It's just like, I think standard is acquisition fee, certainly an asset management fee. And if they're vertically integrated, a property management fee. The one I'm not as hot on is a disposition fee. But really looking at, especially on the acquisition fee, if someone's charging a 4% acquisition fee, I think that's way too high, right? And obviously, if the larger the deal, you have 4% on an $80 million acquisition, like that's obscene. And our tool basically gives feedback that says as much. Like the dilution created from that fee is way outsized. So if it's a multifamily deal, I think something in the 1.5 to 2% is reasonable, right? And I think it's earned. And I think if they had to look at 50 deals to find one, I mean, some of that fee you're paying is all the work they did on the deals that ended up dying. And then an asset management fee, once again, it's my philosophy of fees in general is put the money where the work is. So, be compensated for the value that you're creating. In the case of an acquisition fee, you're certainly adding value, looking at all these deals and vetting them and conducting due diligence. The asset management fee, I want you to be doing work to make sure the asset's going to perform. So therefore you should be compensated for it. If you're managing the property, you certainly should be compensated for it. So really here, you're just looking for outliers, mainly on the high side. And I can get around a disposition fee, but once again, like that's the whole reason we have the promote. Why do you need to be paid why do you get another bite at the apple before we split? Not a fan.
Hey, Lance, I wanted to dig into that just a little bit, because I've heard a lot of operators that have different philosophies about disposition fees. And one of the most common things I'll hear is that, and I'm not a huge fan of them either, to be honest. But one of the most common things I've heard is, well, it's work to go out and market the property and to sell it. Shouldn't there be some sort of fee aligned with that work there? What's your reaction to that?
Well, I agree, and like that's where my philosophy: put the money where the work is. But I'm also saying you're about to earn a promote, so
Yeah.
you're going to be rewarded by being successful at doing it. So therefore, like because you think about if you got a disposition fee in the case of where it's a sideways project, now you're taking money and you didn't do anything. Like I just don't like it's misaligned. So
How often do you see disposition fees? I don't see them very commonly, to be
not
honest.
anymore. I mean, saw them more, 4 or 5 years ago when
Yeah.
it just seemed like people could throw anything in there, but certainly not of late. But I'd say 25-30% of the time you still see them.
Right.
And then these are the fees that you just have to really pay attention. I mean, a loan guarantee fee, I mean, I'm fine with it. I mean, 50 basis, 0.5% to 1% is reasonable. 3 is way too high because to me, they're obviously putting their own balance sheet on the line. guaranteeing the debt. It's just like increasing the interest rate. That's fine of the loan amount, not some forever sort of thing that they're earning. I think that's more than reasonable. Refinance fee, you know, I could probably get my mind wrapped around it because there is work and effort there. Um, and then, but capital formation fees, any capital transaction fees. I mean, there's all these, anything that has some other name, not as much of a fan. Construction management fees, like on deep value add deals where there's, once again, like they got to oversee the general contractor, they've got to do these things. I think that can be reasonable. So if you use a litmus test of are they putting the money where the work is value being added by that fee, and is that reasonable? Then you can be okay with it. But if they're just slamming in all sorts of random fees, I just don't think it's necessary. Um, yeah, so ultimately, right, like in all these cases, you see something seems fishy. It's just they have to be able to defend it. And this is what I teach all my clients. Like, whatever you come up with, you need to be able to defend it in a compelling way, right? Like, you have to have a compelling response. It can't just be, well, that's what everyone does or whatever. Like, you've got to be able to justify any fees that you're charging, period. And so just know that on the LP side, that's what you want to go for. And ultimately, I try to push everyone into use vanilla structures. Don't get cute. You can't innovate by coming up with some really crazy structure. It just, anytime you see that kind of complexity, I would just tend to look the other way. Like, they think they're being creative. I don't need them to be creative in that way. Go be creative in how you're going to find more tenants. Go be creative in how you're going to, like, increase rents. Don't use your creativity on the capital structure. So the next thing we look at, right, key inputs of rent growth. So these are just, we
Hey,
want to look at,
Lance,
go
would it
ahead.
be a good time for me to stop and ask a couple of questions that are in the chat?
Oh yeah, go for it.
Yeah, so we have one, and feel free to keep this one shorter, but we have a question about do you manage any properties that are not in the United States or have experience in South American properties?
No.
No. Okay. Glenn is asking, Lance, do you measure operator competence by proxy things like speed of delivery of K1s or just the deal numbers?
Yes, I do. Because that shows are they organized, and everything about real estate requires order and process driven. I also, the thing I didn't mention is I'm a big fan of strong culture, good, healthy culture. So seeing they actually have core values, seeing they have a purpose, mission, all that stuff, OKRs, like Intel stuff. Like, when I see that they're running EOS or like the system that I've built, that gives me more confidence that there's alignment internally. And I think that stuff matters.
All right. RT is asking, what does effective gross income mean on the fees side? How does it differ from regular gross income?
Well, effective gross income is just like the cash they actually receive, right? Because you have, we have like, here's all the rack rate rents for all the things. Well, then you've got, it's like how much cash are they actually collecting? So they're actually being compensated on a percentage of what they're collecting.
Yeah.
Effective
And
gross income.
then Glenn is asking, do you see operators who take a hit when AM doesn't perform, or is it always charged regardless of performance?
Yeah, I mean, it's charged regardless of performance. So this is why I say, like, you got to do your job to make sure that they're competent up front. If they're not performing, they got to keep the lights on, because if they're not being paid and they're going to keep taking things away from them, right? Like, that's the last thing that you want, right? And this is why I tell my clients, like, because a lot of them, like, I'm going to subordinate my asset management fee, and that's going to be a differentiator. I'm like, don't do that. But why? But I want to say that, and I'm like, don't do that, because then what happens is this deal goes sideways. You're going to run, right? Like, you have there's no incentive for you to stick around and see it through. So that's not good for LPs. That's bad for LPs, even though they might in the surface think it is good for them. It's not.
All right, that's all the questions that we have currently. If you have other questions, feel free to put them in the chat.
Right. So when it comes to rent growth, I mean, I won't go through all this stuff. But I mean, for me, when I'm looking at a deal, I'm looking at, I don't want them to see in year one, especially if it's value add of any kind, that they're going to come out of the gates with just huge rent growth in year one, right? Like, that's usually a red flag. I mean, it's not to say they won't actually pull that off, but when it comes to these assumptions, I want them to be like base case reasonable. That's what conservative underwriting is to me. It's like, let's not assume any of the good stuff will happen. Let's just assume that it's, like, none of the good stuff will happen, because we're going to have other things we're going to have to deal with. So you see people coming right out of the gates with strong rent growth in year one. That just tells me that And especially if they're also simultaneously telling me they're conservative underwriters, I'm saying that's not conservative underwriting. That's aggressive underwriting. And if you're, and just so don't, I mean, even if you pull it off, I don't care. That's great. Then it's just like under promise, over deliver. So those are the things to look at. And especially in year one, if they've got an aggressive renovation schedule, I mean, like you're taking units offline to renovate them along with everything else. Like, how in the world can you grow rents in that environment? That just seems impossible. So that's a sign that you're dealing with an amateur, in my opinion. And then the exit cap rate, I mean, this is a big one that gets picked on all the time, which it rightfully should, because this is the one way I can juice a pro forma very, very easily. And any small increments of change on the exit cap rate, so that's the cap rate based on the NOI in the year that you're selling it, you change that by 0.5%, that makes a big difference in what the sale value will be. So the main thing that I look at, and even in this environment, and I've heard people lately trying to argue why they should be able to do this, but once again, to be a conservative underwriter, I need to assume that cap rates won't compress, but that they might expand, right? I don't know, because 5 years from now, I have no idea what's going to happen. So to be conservative, then I should say, well, I bought it at a 5 cap, and I'm just going to plan on, I'll just assume we sell it at a 5.5 cap. So 0.5% higher than we bought it at, which will reduce the sales price. I mean, that just seems prudent. But anytime you see where they're buying it at a 5 cap and they're going to sell it at a 4.5 or at a 4, that means that they're basically telling you that they're banking on cap rate compression. They're banking on 5 years from today that cap rates will be less than they are now, which once again may be true, but who knows? Like, none of us have a crystal ball. So that's why I don't like it, because it's just like, you don't know and you have no control over that. So why would you project that? Right? Especially when we're all driven to looking at the IRR and the equity multiple, and that's going to make that number much higher. So this is how you can suss out deals really quick. I mean, once again, I think independent of whether they can try to argue it, it just tells me a lot about them, right? It tells me that they're not underwriting conservatively. They're being very aggressive in their underwriting. And unless they have something, and once again, I want to hear them out. Like, defend why you think this is okay. And there may be situations where it's completely reasonable what they're saying, but it's just, this is the kind of stuff you want to push back against, because often we're anchoring our decision to those net IRR projections and equity multiple projections. It's very sensitive. And then the next thing is, comparing the T12, which many sponsors don't sort of provide you with that visibility, which drives me crazy. Because to me, when someone sends me a deal, my next question is, can you send me the underwriting? I'm just used to it. Obviously, when you write bigger checks, they give it to you, but I've realized that most LPs, they don't share the underwriting. Like, you get whatever's in the OM, the PDF, and that's it. So the big red flag for me is when I ask for the underwriting, they don't give it to me, then I just walk away. Because to me, it's like, it's not secret sauce. Like, we're all using the same stuff. And if you think I'm not competent enough to review it, whether I am or I'm not, it doesn't matter, right? Like, I should be able to see what went into all your assumptions and everything that you were evaluating to come up with the numbers that you're preparing, providing to me. So this is where I want to look at what happened in the last year that someone else was owning it. And I want to see that they're being conservative coming out the other direction, that they're not immediately thinking that they're going to go, once again, not to say that they won't be able to do that, but I want to see that they're just going to assume that the expenses will be greater in the first year than they were with the previous owner had. Right? Just because that's just a conservative assumption. We have no idea. We haven't gotten into it yet. We've had limited access to the property. And there could be situations, like I said, it could be some major water leak that you're aware of, and you just know the water bill is going to go way down. But it's like, line by line, that's what you want to see. Why is this line higher? Like, or why did you say that the expense would be lower? And then I want them to give me the explanation. Oh, because there's a major water leak that we're going to fix, and it's going to go down by this much. Okay, that's reasonable. That makes sense to me. And then the other one I like is yield on cost. And really, we all talk about purchase cap rate, but purchase cap rate is basically the NOI, based on, and then the cap rate. Well, just based on the purchase price, I should say. But the reality is that most of these cases, that you have the purchase price and you have all the fees that are going, the acquisition fee, the closing costs, and then you've got some CapEx budget, right? They're going to do some renovation. So really, yield on cost is taking all that into account. It's taking the purchase price plus all the CapEx and fees, total capitalization, and then taking your year one NOI and then dividing it by the year one NOI. Now we've got a yield on cost. So even if they went in at a, here like 6 cap, we're buying it for 20 and the NOI is, year one NOI is 1.2 million. That's a 6 cap. But if we have additional total capitalization, the project is 24 million, 20 plus 4, then the yield on cost would be 5, right? So this is what we're up against now. With all that extra stuff, we're now at a 5 cap off of the NOI. So we need to drive that higher to get to where we're trying to go, right? And if we've got a projected exit cap, conservative 6.5, which is 0.5% higher, now we're going to have to move that operating cap rate, which is, that last year NOI, over the going out cap rate of 6.5. We need to be able to demonstrate that we can move that to at least 8.5 so that we're creating a spread. That's how we add value. And this is what I look at just to see, like, is it too skinny? Like, are they going to be able to pull this off? And just using the example here, right? Like, if they're saying that we're starting at 1.2 and we're going to drive the NOI to 1.9, everything I'm looking at is that how reasonable is it they can increase NOI by 700 grand? Like, that's what I want to see. Like, how are you going to do it? Like, what are you going to do to make it go from 1.2 to 1.9? What are all the things that have to take place to make that happen? And if their own pro forma isn't supporting creating that 150 to 200 basis point spread between the yield on cost and that, the sale year operating cap rate, then it's too skinny. Like, the chances of them pulling this off are just, it's not worth all that to say, like, it's not worth doing the deal. Like, they should have passed on this deal. It doesn't make any sense. And I had a client that had a deal like this the other day where we looked at it and it's just like, this deal doesn't make sense at $13 million. Like, it's impossible to make this work. It doesn't pencil. Next. But you need to check their work, because not all these guys are doing that. They're just getting caught up on all the assumptions, all the hype of their own deal. So then when we look at, like, okay, great, we've done the quick thing and it seems like all the stuff is within line. That's when we go in to do a full underwriting. Now we're really going to start to dig into that business plan and the market and the property and, really testing those things, really digging into the operating income and expenses, looking at those stabilization X assumptions, doing some sensitivity analysis, and then really digging into the sponsor. As I said, I usually do that first before I even look at a deal, but I get it. We get excited. We want to kind of look at a deal first. Then we'll go, okay, these guys any good? So I'll flip through some of this stuff. I mean, I think you guys understand most of this. I mean, obviously the location stuff, looking at, where these things are trending, like in our tool, these are the big ones you want to look at. You want positive population growth, rent growth, household income, all that kind of stuff. Renovation schedule is one to look at. Like I said, it's usually the sign of an amateur if, like, they say they're going to rehab 50% of all the units in 1 year. Like, it's the same thing. Like, you got to sanity check it. Like, you're going to renovate so many units, like, that will take time. And if they're going to do it on some expedited thing to get out of the deal, like, I just want to know, like, how in the world are you going to pull that off? And then looking at their income projections. So the big things are, like, are they including a loss to lease? Are they including vacancy losses? They're a bad debt. Like, because sometimes they just leave that stuff out of there. Like, oh, that stuff magically won't happen. Well, it's going to happen. Like, people will rent your place that won't pay you. Bad debt. I want to see at least 2 to 3%. Just assume, like, once again, like, that's just a reasonable assumption. If it doesn't happen, great, but it might happen. And then your vacancy loss, the same thing. Like, why are units turned off? They're being renovated, or concessions, things like that. If they just don't have these things in their pro forma, it just tells me a lot about them. And then the other one I like to look at is projected break even occupancy. So, it want it to be 75% at the highest, but you want a lower number. You just want to know that there's, like, headroom in this thing, because if it's the higher that is, that means that if the occupancy starts to fall, now you're in trouble with the lender, right? Like, and this is where, people have seen these issues, and now it's more real for people today than it probably was 4 years ago. But you can calculate this, and the sponsor should be able to give you this kind of information. And then some of these things we've already talked about. Property taxes are a big one. Insurance are a big one. So if they're not projecting that property taxes will be higher or insurance is higher, it just shows you that they're sort of out of touch, as far as I'm concerned. And then the other thing too is just looking at that NOI growth. Like, if it's just super steep curve, I mean, that's another, it's just kind of like exit cap. Like, really, like, I mean, 10%, you're going to grow NOI 10% a year. Like, maybe, but I really want to hear how you plan on doing this. because, and especially in this market where like we already saw the rents go all the way up, like it's just, maybe it could have been in 2017, 2018, like there was just so much meat on the bone. But these days, like that's really tough sledding. I mean, because I think rents are actually coming back the other way, right? And then exit assumptions, the other little trick is sort of using the exit cap rate on the forward year NOI. So like it's, instead of it being like year 5 on a 5-year hold, it's projecting it on year 6. So year 6 NOI at the cap rate. It's just another little way they can kind of juice the returns. I don't like it, right? Like just use the exit year 5. And then debt, we've all learned a lot about debt in the last few years. So just, obviously you got loan to value and then you got loan to cost. You want to look at those things. And then the types of debt, this is what killed everybody, right? This killed many deals. This killed many deals. The guys who are sleeping well at night are the guys who took fixed interest rate debt at higher interest rates, and they're the ones who are sleeping like babies, right? So now, whether, once again, did their projections look as good? No, they didn't. But a lot of people felt pressured to do this because investors, LPs, were just glomming right onto the numbers and they were just putting money into deals with the best numbers. If you take anything out of this conversation, it's that don't do that. Seriously, figure out whether whether the group is actually conservative underwriters, and if they are, per the criteria we've just laid out, and they're saying it's a 12 IRR, 13 IRR, whatever, like understand that that's actually what we want to be looking at. If someone's just popping up all these numbers and telling you they're going to be an 18, now you can tell whether they're an aggressive or a conservative underwriter. And if they're aggressive, then you can just throw the whole thing out. Like it doesn't mean anything. And it's just, this is that investing behavior that sort of is, it's just like baseball and steroids in baseball. All the guys felt pressure to use steroids because it's like their next contract depended on it. Right. And I think it's the same thing with operators and sponsors. They just felt the pressure to have to juice some of these things because everyone else was doing it. Well, stop the madness. I mean, we can stop it. LPs, we can stop this. Bridge long-term debt. And then now, this is obviously, we're in the negative leverage situation here, right? Where the purchase cap rate versus that interest cap rate. When the interest rate's higher than the purchase cap rate, we have negative leverage. So what that means is, I mean, it's not great. Is it insurmountable? I mean, the core deal, probably not so great, right? Because like they don't have any levers to move, right? They're paying more, like the income it's generating versus the interest they're paying out. You're paying more in interest than you are in generate income. Not good. Now, if they can figure out a way to, move and add value quickly, they can get out of that negative leverage situation. They have some control over it. But I mean, I certainly don't love the fact we're in the negative leverage environment, especially multifamily guys. They're paying 6.75% interest and they're buying properties at a 5 cap. Not ideal. Debt service coverage ratio, I think we all probably understand that. And so here's where we get into the tool. Go ahead.
Oh, I was going to say, anytime you want to stop for questions, we've got enough to take us to the hour. But if you want to keep going, we can do that too.
I'm just about done. So yeah, we'll just wrap up. So all that said, so in our tool, and so we have the spreadsheet version available now, but we're in development. We're about a month away from going into beta on our online version of the tool, so it's more, 21st century stuff. But nonetheless, one of our concepts, right, is the GP alignment. So we're looking at how much the fees that are being paid to the sponsor and the promote is diluting our position as LPs, right? And that's, so all the things I said, you plug in the numbers, it's going to spit out and tell you, in this case, they have a really, really high acquisition fee. It's creating 1.65% dilution. And then their promote, because they had a super high 50-50 split or something like that. That's creating, crazy dilution. So this is way, way out of range. We want to see 3 to 6%, right? Like that's fine. Like they're earning it. That's fair. That's a well-aligned deal. But when it gets out of range like this is not well aligned. I mean, their interests aren't aligned with yours. And that's the stuff that you don't want to invest with people where there's not great alignment. There's always going to be conflicts of interest. They can't be avoided, but I want, great alignment. And then the other side is looking at deals, especially like value add multifamily deals, is just, this is where you can see if they really puffed up on that exit cap rate is the IRR partition. We want to see if all the cash flows on a net present value basis, how much of those cash flows are coming from the sale versus that's coming from operating cash flow. right? And so when we start to see this creep up into 80, 85, 90% of all of that, that IRR that I'm being quoted is being generated from the sale of the asset, that starts to look more like a development deal, right? And so if I'm going to do a ground up development deal, I want to be compensated a heck of a lot more than I do on some medium, light value add multifamily deal, right? I mean, I want 25% return. I want a 30% return. Um, so that's another thing to keep an eye on that our tool sort of shines a light on. And then ultimately, then we then score, sponsor market deal. We can kind of see these things. It's just trying to give better visibility. In one, it's a teaching tool. It's to help you understand why the things we just talked about matter, and then also give you visibility into, what's really going on. I call it shine a light on it. Like, what are the areas you really need to dig into and conduct more due diligence, ask the next level of questions. And then this is, kind of show, like I said, red, yellow, green. So these are the things that I might want to focus on, those red areas. And it just makes it easier. I don't need to worry about the green stuff. They're within tolerance. It makes sense. I just might need to look at some of these things that might be a bit aggressive.
All
And then
right.
we
Oh,
talked a bit
go
about
ahead.
that. Yep. So that was that.
Question and answers, here they come. I'm actually going to start at the bottom with Rodney. He's asking, how do you evaluate climate change issues in a given area for a property that you're considering? He has an example where he bought a great property in a non-flood zone, but was shocked when he had flooding and sewage backup. How do you evaluate climate change issues when looking at a
Yeah, well,
property?
I think for me, like I said, everything comes down to, like, I look at it and say, what am I being offered? What kind of return am I going to get? And then I stack all those risks up, and then I ask myself, am I being compensated for the risks I'm taking? So if you're buying a property that's not in a flood zone, but you've done enough due diligence to know that it could become in one, like it could happen. Now I'm saying, well, I need to be compensated more, meaning it's not a 9% return or 10%. It might need to be a 12% return to compensate me for that risk. So everything's about, I read a PPM or whatever, I go to the risk section and I'm looking at every risk and going, okay, how likely is that going to happen? And how much more should I be compensated for taking on that risk? And that's why I said, like, the development deal. I want 30% return because, horizontal development and vertical development terrify me. There's lots of moving parts there, lots of things that go sideways that are out of the control of the guy running the project. I need to be compensated for that risk that I'm taking. My money could be out longer. I could lose my money. So what is it going to take to pay me for taking that risk vis-a-vis doing something else?
All right, I'm going to jump over to Ashish's question. He's asking, can your company provide a list of sponsors that pass your vetting process?
Great question. Yeah, so no, we don't have that. In fact, Daniel knows, like, that was one of the things I was working on at Verivest, was creating, the sponsor vetting. We did it. We verified track records, and a shocking development, sponsors hated it because they like to be opaque more often than not. They don't like to be transparent. They don't want to be under the microscope. So no, we don't have that. But eventually, our plans are to eventually expand this into sort of a marketplace where we can match, people up. But we always want to be completely independent. If not, if anything, more LP focused. I don't want to be raising money or doing things for the sponsors. I think they need to prove themselves. But we like to be, more analytical about our approach.
We've got two questions that are surrounding the rates of compensation. I'll just read them both off, and maybe you want to take them one by one, or maybe you can put them together. AB is asking, are there good rules of thumb of IRR and total fee rates, namely with interest rates today? For example, a 10-year treasury plus a certain percentage.
Yeah.
So what are your rules of thumb for IRR and total fees? And then I'm going to ask Glenn's at the same time here, and you can take them separately or together. Do you have a table of expectations, like common equity should have 800 basis points on a fee rate of return? Debt is 600. Both questions are around, how do you
Yeah.
assess the
Risk adjusted
fees?
return. Yeah. Risk
Risk
adjusted.
adjusted return. Yep.
Yeah. 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 Yeah, I don't have a good answer. And I've tried to sit down and come up with something that would make sense, like, that could do that. I think the reason it makes it's hard is because all of our risk tolerance is different. So, like, right now I'm pencils down with anything multifamily because I just don't, because, like, I get it. Like, it could be a solid deal. They could execute, all the things go right. I don't like 13%, at that. It's once again, like it's just given what I could get something else, I just don't like it. I'd rather invest into debt where I could get maybe, like 9, 10, or 11 or something, right? So everything has to be compared against something else. I can invest 100 grand into this or that. So I think that's how you have to assess it, right? And it's yeah, it's more complicated than that. I don't have a great answer.
Yeah, it is complicated. Not only does it depend on the investors, risk tolerance, but location, sponsor, debt. There are so many variables that it can
So
be
many
two
ways.
properties next to each other could have completely different metrics, and two properties on the other side of the nation could be very similar.
Yep.
Yeah. Okay. Glenn asks a lot of questions here, which is great. Do you have an updated insurance growth model depending on a region? For example, typical insurance growth might be 3%. Doesn't seem to be a viable assumption currently. What is your belief of what is likely? So, do you have a model for insurance
I mean,
premium
I
growth?
don't, and it's super volatile. And so I guess my question to them is do you have a quote on insurance? Like, did you go to market? Because that should be part of their diligence, right? Where
Yep.
they're actually going to the agent saying, "Hey, what's it going to cost for me to bind on this property?" But, I mean, so that's where I want them to have done that, and then I want their pro forma to basically reflect what their findings were. So that's the answer I want. I have no idea what the right answer is, but I want, you can find
I,
out.
I
Yeah,
will say that it is worth noting that insurance costs rising rapidly has been one of the largest expenses going into a lot of these deals here recently.
for
Um,
sure. For sure.
there's certainly
Yeah.
been a huge insurance bump recently. Prolet is asking, what are current typical IRRs you are looking at that seem realistic based on the items you mentioned? So what's a
Yeah.
realistic IRR? And I
Well, like,
assume
so
this
if I
is
looked at
probably
a
for
group that I've known, yeah, a group that I'll just use it as example. It was a deal in Little Rock, Arkansas, and they are historically conservative underwriters. I looked through their deal, ran it through our tool, and they were projecting, I think, 12. It was a lighter value add multifamily deal, assume debt assumption, and it was 12 and a half or 13% IRR. And it's in Little Rock. That's obviously not a primary market. It's borderline considered a secondary market. Um, but that was a solid deal. Now, once again, like for me, I mean, I'm going, this was conservatively underwritten. That seems like, it's in the go zone from a yield on cost, like it's go zone with all the stuff. Like it scored well in our deal analyzer, but I just wouldn't have put money into it.
all right. And I'm jumping back up to Mario. I missed his question up here. He's asking, what's a typical rent growth that you look for? I know
Typical
that's
rent
a
growth. Yeah.
it depends question.
Yeah, it depends. I'm more interested in just looking at something that's outlier, right? Like, I mean, I'm looking at like rent growth 2-3%. It's just I want it all to kind of tie together when I go and look at what's the market at, like, like okay, these guys are $150 a month, below market, right? And then so that's more of how I'm triangulating it. I just don't want it to see it just like spike and be crazy, right? Because that's what I'm going. That's why I say in the quick vet, I'm going, something seems wrong here. Like it just seems way too aggressive. Then I want
All
to
right.
dig into it more. Yeah.
I know we're coming up on the top of the hour here, but I'm going to ask the last two questions we have. One's quick, I think. AB is asking, how much time do you spend when you do your due diligence?
Yeah. I mean, a deal that I actually end up doing, probably 3 or 4 hours. Um, like running it through our tool, it's probably, 30 to 60 minutes, depending upon how much stuff I have to like go retrieve that I wasn't provided.
Okay. And Ashish is asking, can your tool use AI? And, I guess this is your future business tool that you're rolling out. So feel free to answer,
Yeah.
say it's a trade
Yeah. The
secret
new,
or
yeah, the
whatever.
new tool. Yeah. The new tool is integrated with ChatGPT. Um, yeah. So it goes and grabs, a lot of those market metrics for now. And then we're looking at, just uploading all the OM and the PPM and then, letting AI sort of go and retrieve answers. So that's what we're working on. So yeah, AI is a big part of what we're doing.
Nice. All right. We have all the questions exhausted here in the chat. So
Oh,
congratulations on that.
yeah, very
Hey,
good. Well, I I appreciate it. I do have to bump to the next thing. So I appreciate everyone's time. Yeah, feel free to go to passiveadvantage.com,
Lance,
connect with me on LinkedIn. Happy to help.
before you drop off,
Yeah.
can we have everybody take themselves off mute and thank Lance for coming in?
Thanks, Lance.
Thank you.
Thank you.
Thank
Thank
you.
you. Appreciate it.
My pleasure. My pleasure. Take care. We'll see you guys.
We'll see you here next week. Every single week where we're learning to improve our investment skills at the Alternative Investment Club. Have a wonderful Mother's Day weekend.